The consensus view of the market is that it's not going to change a whole great deal.
Okay, but I mean, how often in the past has the consensus helped you at inflection points? It's not just that we're losing Janet Yellen. We've already lost Stanley Fischer. We lost Tchir. We're going to lose Bill Dudley.
Yeah.
So we're losing 43 years of cumulative monetary policy experience, and so far we're trading in 6 years. So it's an untested, inexperienced Fed, and the fact that that's not what people are talking about actually makes me comfortable, because I made a career out of looking in the other direction than the consensus.
Peter, should we be looking in the other direction, and are we at that kind of inflection point that David describes?
I actually disagree a little bit. I think Yellen's whole job is to be hawkish going out. She's supposed to set the table for hawkish statements so he can come in and actually be dovish. We kind of lost the ability to jawbone over the last two meetings. Both times the Fed tried to be dovish, the markets didn't respond. I think they've made a very concerted effort over the last month and a half to push us towards the dots, to talk hawkish. That gives Powell the chance to step back. Let's be honest. If you start a new job and you don't hike rates, no one's going to yell at you. If you hike rates and the economy slows, you're in big trouble.
But I mean, Peter, every new central banker comes in and no matter the circumstance, feels compelled to flex their anti-inflation muscles. Go back to McChesney Martin. Every new central banker feels that they're almost forced to have to raise interest rates. I've never seen actually a new central bank chairman come in and cut rates. Do you?
Fortunately, though, this guy's not an economist, right? He's a banker, a lawyer, and a politician. I think
his name was President Mario Draghi, who pulled off that exact feat, David.
It's almost borderline disingenuous. Like, I'm not in the big inflation camp. I know we're going to talk about that.
Yeah, we're going to get to that.
No question that there's cyclical pressures.
Okay.
But, I mean, to go in there and say that, oh, there's no wage pressures whatsoever, I'm there thinking the last Fed beige book, there are wage pressures everywhere. How can you go on the public record and say that we're not seeing any wage pressures? It was actually, for the first time this cycle, the most broadly based commentary on wage pressures out of any beige book in the past 8 years.
I want to cross over to Barry Bannister and get his insights. Barry, we're talking about this comfort around the Federal Reserve through next year. The consensus is that the S&P 500 goes high, yields go with it. But I don't see a consensus call for lower multiples as central banks pull back in a significant way. How should we be thinking about this?
Yeah, obviously the Treasury yield is the base rate. Then you're going to have a credit spread. Equities would not discount to Treasuries. They're not risk-free. So you would use corporates, and it would be the corporate market that matters more. Spreads are very low on mid-grade corporates. Any upside that I could see in the near term would have to come from the Treasury, pushing up the yield on the corporates, which we expect. If it pushes it up more than the growth in earnings, then you would see a topping out of the market, and some of that would be PE-driven.